Considerations when trading a new instrument. Quite often during our trading career, we'll be tempted to look at different ways of trading. Part of this may be to look at different instruments. So for example, you may start off being an FX trader and decide to have a look at share CFDs. As part of our preparation to do this, then we need to make sure that we're adequately prepared to do this. We'll start by saying, of course, that there is much that is transferable when considering trading new instruments. How markets move, what moves prices. From a system point of view, the need for trading plans and measuring performance of both your system and yourself. And of course, from a psychological point of view, there's the ability to follow through and be disciplined in what you're doing, both on entry and exit. But there may be several differences which are crucial to know before you start to trade a new instrument. The first of these is the pricing, and this is the actual pricing of the instrument and its structure. So for example, it may be that you're used to trading Forex, where you're trading in pips, whereas if you move to other instruments, you may be trading in cents or points. Additionally, within instruments, even within a specific umbrella of such, there are different ways of pricing. So for example, if we look at the S&P 500 as an index, it's priced differently to that of the Nasdaq. So knowing this is actually really crucial information. Part of that, of course, is to understand the pricing currency. If we're trading an index, for example, the currency in which we're trading will depend on which index it is. If we're trading the FTSE, it'll be priced in GB pounds and then converted back to Australian dollars. If we're trading the Nikkei, it'll be priced in yen and then converted back in. We need to know minimum maximum trade level. With FX, it's 0.01. With indices, for example, it's 0.1 of a contract. Margin requirement will differ not only between instruments but also within instruments also, and will also depend on, of course, whether you're a professional or a retail client. It's important to know this so you don't put yourself at risk of margin call. What moves prices and the risk associated with specific instruments is also critical information. For example, and on a simple level, if we look at interest rate decisions, if there is a hawkish tone to an interest rate policy statement or a rate rise when it's not expected, that would be bullish for a currency but negative for the index related to that particular interest rate decision. There are also differences in terms of when price moves and how they move, even at a basic level of volatility. For example, a 0.5% move in FX is very significant compared to that of a 0.5 move in a share CFD. Even within instruments as well, we have different volatilities for different sectors if we look at the share CFD world again. And also, of course, prices tend to move at specific points in the day or be more prone to move at specific points in the day. So, for example, when new exchanges open in the FX market, we would expect more action. So when the European market opens, and so the European and the back end of the Asian market are open together, there'll be more significant moves. There's more market participants there. And likewise, of course, and even more so when the US and the European exchanges are open. With share CFDs and shares as well, we tend to get more movements at the start and the end of the session. Market hours relate to this, of course. Don't make the assumption that things trade 24 hours a day, 5 days a week, because this obviously isn't the case. There are differences between when some futures markets open and close, some indices open and close, and of course the obvious in that share markets are only open for a small period within a day. There'll be variance in market liquidity at various times during the session as well. For example, at the back end of the US session, we would expect trading volumes to be quite small, and that may impact on spread. And finally, of course, the costs of doing trading business. Again, these will differ depending on the instrument. With share CFDs, for example, there's a brokerage applied. Swap will differ depending on the instrument. And of course, with share CFDs, there's dividends positively or negative depending on whether you're long or short. So what we want you to do is go away, look at this list whenever you're considering a new instrument and just tick it off in terms of, yep, I know that, yes, I know that, yes, I know that. Once you can put ticks beside all of these, you're ready to go.